Okay. So let's say you've got some money saved up. Maybe it's like a few $100s, maybe it's a few thousand. And you're sitting there thinking, okay, I should probably do something with this money. Like, I know I should be investing or whatever, but like, where do I even start? And so you go online and suddenly there's just like a million different things. You've got crypto, you've got stocks, you've got index funds. You've got this guy on YouTube who says he turned $300 into like 100,000 in 6 months, which like, okay, sure, man. And then you've got your friend who bought Bitcoin back in 2013 and now he's like insufferable at dinner parties because he won't stop talking about it. And you're sitting there thinking like, man, if I had just done that, I'd be rich right now without having to do any work. So there's all of this noise and all of this confusion, and then on top of that, there's like this very real fear that you're going to put your hard-earned money into something and then just lose it all. And and that fear is actually what stops most people from ever starting in the first place. So in this video, I want to break this whole thing down properly. Like actually explain how investing works, what you should be putting your money into, how much you need to get started, and also address all the fears because I had all of those fears too, and I think it's worth talking through them honestly. And I'm going to split this into a few different parts so you can kind of follow along easily. We're going to talk about why you even need to invest in the first place, then what to actually invest in, then how to deal with the scary stuff like what if the market crashes, and then at the end, I want to talk about something a little different, which is like a faster way to build wealth that most people don't really think about when they think about investing. Okay, so let's start from the very beginning. So the first question is like, why do you even need to invest? Like, why can't you just put your money in a savings account and call it a day? And the answer is something called inflation, which I know sounds like a boring economics term, but just bear with me for a second because it's actually really important. So basically, what inflation means is that over time, your money loses its purchasing power. So, like, the same dollar today buys you less stuff than it did 10 years ago. And you can feel this in your everyday life, right? Like, if you think about how much a coffee cost like 5 or 6 years ago versus what it costs now, or like groceries, everything just keeps getting more expensive over time. And so if your money is just sitting in a bank account, it's technically not losing its number. The number might stay the same or go up a tiny bit. But what you can actually buy with that money is going down every single year. And the US Federal Reserve actually targets around 2 to 3% inflation per year on purpose. That's just how the system is designed. So the whole point of investing is to grow your money faster than inflation is eating it. And historically, the stock market has returned something like 8 to 10% per year on average over long periods. So if inflation is taking 2 to 3% and your investments are growing at 8 to 10%, you're actually coming out ahead in real terms. And then there's this concept called compound interest. Basically, your money makes money and then that money makes more money and it keeps stacking over time. So if you invest $1,000 and it grows 10%, you now have 1,100 next year. 10% of 1,100 is more than the year before because your base keeps growing. And over decades, this becomes massive. Like $1,000 invested in the stock market in 1980 would be worth over $17,000 today if left untouched. That's the power of time and compounding. Okay, so now we know why investing matters. The next question is what do you actually invest in? There are a lot of options: real estate, individual stocks, crypto, bonds, art, collectibles, even luxury watches. And I'm not saying all of these are bad, but for most beginners, the simplest and most reliable answer is index funds. Specifically something like an S&P 500 index fund. Um, an index fund is basically a basket that tracks a market. The S&P 500 is a list of the 500 biggest companies in the US. That includes Apple, Microsoft, Nvidia, Amazon, Google, Meta, and hundreds of others. So when you buy an S&P 500 index fund, you're not picking individual companies. You're just buying a tiny piece of all of them at once based on their size, which means you're not betting on one winner. You're betting that the whole economy of large US companies will keep growing over time. And I know what you're thinking because I thought the same thing. Why not just pick the winners? Why not just buy Apple or Nvidia or Tesla? And this is where it gets interesting because the problem is nobody actually knows who the winners will be ahead of time. Take Kodak, for example. In the 90s, it was one of the biggest companies in the world. Everyone used Kodak film. They even invented the digital camera in 1975. But they didn't pursue it because they thought it would hurt their main business. And eventually they collapsed and filed for bankruptcy in 2012. Or Blockbuster. In 2000, they had thousands of stores everywhere. They literally had the chance to buy Netflix for $50 million and refused. A few years later, Netflix took over and Blockbuster disappeared almost completely. And the point isn't that you should avoid companies like Apple or Nvidia. The point is that even the biggest companies can fail when the world changes, and nobody sees it coming until it already happens. That's why even Warren Buffett recommends that most people just buy index funds instead of trying to pick individual stocks. Because even professional investors who spend their entire lives studying companies usually fail to beat the market over long periods. So if experts can't consistently do it, it's unlikely that most regular people will either. That's why the simplest strategy is just owning everything instead of trying to guess the winners. Now, there's also a global version of this idea. If you're worried about only investing in the US, there are global index funds that spread your money across thousands of companies in different countries, like Europe, Japan, South Korea, and emerging markets. So you're not betting on one country, you're betting on global economic growth over time. Now, the practical question is, how do you actually invest? You do it through a brokerage account. That's just a app or platform where you can buy investments. Examples are Fidelity, Schwab, or Robinhood in the US, and trading 212 or similar platforms in Europe. The process is simple. You sign up, deposit money, search for an ETF like VOO, which tracks the S&P 500, and buy it. You don't need a lot of money either. Many platforms let you start with small amounts, even $10 or $20. And with fractional shares, you can invest in expensive assets without buying a full share. Once that's done, you officially own a piece of hundreds of companies. Now, one of the most important concepts is something called dollar cost averaging. Instead of trying to guess the perfect time to invest, you just invest a fixed amount every month, no matter what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, it smooths out your cost. But more importantly, it removes emotion. You're not trying to time anything, you just automate it and let it run. And over long periods, this becomes extremely powerful. Even small monthly contributions can grow into large amounts because of compounding. For example, investing a couple $100s a month over decades can turn into hundreds of thousands, even millions, depending on time and returns. Now, we also need to talk about fear because everyone is fine investing when markets are going up. The problem is what happens when they crash. In March 2020, during COVID, the market dropped around 30% very quickly. Many people panicked and sold, but those who stayed invested recovered their money within months, and long-term investors went on to make even more. The key idea is that the market goes through cycles, but historically, it has always recovered and grown over time. That doesn't mean it only goes up, it goes down often, sometimes sharply. But over long time horizons, it trends upward because companies create value, populations grow, and weaker companies get replaced by stronger ones. Um, the S&P 500 constantly evolves. Old companies get removed, new ones are added. So you're always holding the strongest companies of that time period. That's why long-term investing works. And One of the biggest mistakes people make is waiting for the perfect time to invest. The truth is, no one can predict it, and missing just a few of the best days in the market can drastically reduce your returns. So, the better strategy is simple: stay consistent and stay invested. Okay, so now I want to talk about something a bit different because everything I've described so far is what I'd call the traditional slow lane approach to investing. But there's another idea: investing in yourself, skills, education, income, growth, side income, business building. Because sometimes the best return isn't 8% in the market, it's doubling your income through a new skill. So the best approach is both invest in index funds long term, invest in yourself aggressively. Finally, the simple roadmap: build emergency fund, pay high interest debt, open brokerage account, invest in S&P 500 ETF like VOO, automate monthly investing, focus on increasing income. The biggest mistake is waiting to feel ready. You don't need perfect knowledge, you need a starting point. Open the app, start small, and let time do the work. If you found this video helpful, then make sure to like and subscribe for more content like this, and drop a comment below. All right, that's it for this one. I'll see you in the next video.